Hey, we're back.
Hey, happy Tuesday, everybody. Welcome back. It's been about 2 weeks since I've been able to do this. Been traveling a bit,
Three,
Mr.
three
Weathers.
weeks.
Three
Yeah,
weeks.
you
Wow.
missed two, but that means it's been three.
Oh, there you go. There you go. So that's quick math for you. So thank you guys so much for joining us today. Stoffel and I are fresh back from being in Berkshire Hathaway's annual meeting together. What's your 10-second takeaway, Stoffel?
It was fun to get together with like-minded investing dorks.
There you go. I totally agree. So we are here to talk about a company that I think I first researched like 4 or 5 years ago. First pass
Really?
was like,
4 or 5
nah.
years ago?
Yes, that might be stretching it, but they came public. I think during like the 2020 SPAC boom or
I tell
whatever.
you what, if you researched it 4 or 5 months ago, you could have like a 10-bagger.
There you go. I know. People are having issues getting into the webinar. I hope that's not the case. We should be live. Can you check it?
Yep.
If you could check it and do whatever you need to do, but that should be working on our end. We hope that that's working. We always celebrate when the tech works, and as far as we know, it is.
There we go. I'm checking.
Okay, great. But
yeah,
with
we're live on YouTube.
Okay. How about on the private stream? That'd be great if you could check that
That
too.
one I don't know how to check.
All right. So for those that don't know, my name is Brian Feraldi. I've been investing in stocks for 20 years. That's Brian Stoffel. He's been investing for a similar amount of time period. In this series, we take a stock and we research it live from scratch. And the date is wrong there. It is currently May 5th. Happy Cinco de Mayo to all those that celebrate. So the stock that we are researching today is called Bloom Energy. BE is the ticker, and this has been a hyper performer over the last year, up like I don't even know how many, a lot, up a lot. I'm gonna guess at the outset, from what I know about the business, that this is somewhere around here on the difficulty level. You know, some companies are easy to analyze. We've been analyzing a lot of semiconductor companies, which are a little bit harder to analyze. Yeah, we're hoping that this company isn't as hard. So let us know in the chat. Is this a stock that you guys own? Let us know in the chat if this is a stock that you guys own.
I'm getting that the webinar has expired.
I know what I did wrong. Okay, you do really cool stuff, and I will fix that really fast.
All right. While he's doing what he is doing, I will say that I do not own shares of Bloom. However, I do know that Bloom is a company that has gone. Now, listen to this and just think about it for a second. This was, by my estimates, as recently as a year and a half ago, a $4 stock, a $5 stock, maybe let's call it 10, because today it's a $300 stock. And it gets even better. As recently as just February, it was trading for $120 per share, and it's more than 2x since then. So, Brian, I know that I have been doing a whole bunch of research on the AI infrastructure, and the bottleneck is really in two places: chips and manufacturing, and energy. And this is in that energy part right there. We've got one minor shareholder who's up 300 plus. Interesting to see if we still think it's early. That's from Darren. And welcome to those coming to us from Portugal. I'm a little
okay. There, somebody's
Mr.
in. All right.
And Taylor.
It was a bug. It was a bug on my end. I just fixed it. So thank you guys. Thank you guys for coming in. It should be working now.
Great.
Yes. Sorry about that to everyone.
That's okay.
It's
tough to do it in real time, and you just did it.
Yeah, I did. So great. All right, very cool. So the goal at the end of this research period together, which takes roughly about an hour or so to do, we're going to learn how to research a stock completely from scratch. We're going to be using the stock simplifier to do that. It's a 7-step process where we look at the phase of the company, understand the business, the moat, the growth, key metrics, and more. And we always like to start with the phase analysis. We think knowing what phase a company is in dictates the rest of your analysis. So we like to do that. So here I have stock simplifier spreadsheet pulled up. I'm going to put the stock Ticker in Bloom Energy, BE. It's an $82 billion company. I'm going to open up a fresh copy of Fiscal. I'm going to open up our AI prompts, and we have built a custom AI prompt that will help us with this analysis. Now we're going to continue using Gemini for this. So, oops, no, that's not the prompt. Let's go to the prompt. I copied the wrong thing. Here's the prompt. There's the prompt. And it should say, what company are we talking about? BE, Bloom Energy.
Any guesses, Brian, before it comes up?
I'm going to guess phase 2, but that's phase 4. Okay, apparently this company is profitable. High confidence. So it has operating income, 72 million in operating income, revenue growth, 130%, and no capital returns. Well, if it's making a positive operating income, growing at a hyper growth rate, and no capital returns, that sounds like the operating leverage phase to me.
Yep.
Very cool. All right. Well, that was good. So this means that forward numbers are going to be our friend here. Price to forward earnings, price to forward free cash flow. This means for investors, they are maximizing profitability as they scale production to meet massive demand from AI data centers. The swing to positive GAAP. Ooh, that's a GAAP number. GAAP operating income and record revenue growth proves the business model is highly scalable and focus on scalable profits and everything like that. Okay, well, I'm just going to go ahead and believe the AI here that this company is indeed in the operating leverage phase. Now, what that does is it changes the things that we look at in the rest of Stock Simplifier, some of the key metrics that we look at, and more. So good.
For what it's worth, I have them. They were not making an operating profit until 2024, but those operating profits have exploded since then.
Okay. Yeah. Good to know. Good to know. All right. Next, what the heck does this company do? I know a little bit about what this company does, but these are the questions we like to ask about any company. How does it make money? Who are its customers? Where does it operate? How often do customers buy? And more. So let's go to our second prompt here, our business analysis prompt. Let's go over to our to Gemini. Let's paste it in here and we will see what we say. Okay. BE, Bloom Energy.
Now, my understanding is it's all about fuel cells. Again, anything that can help run data centers is an investor's friend right now.
Yeah, for sure. All right. Designs, manufactures, and sells solid oxide fuel cell systems known as Bloom Energy servers that produce clean, reliable, on-site electricity. These systems can run various fuels, including natural gas, biogas, and hydrogen, converting them into electricity through electrical chemical process without combustion.
Without combustion?
Huh. That sounds like magic.
Yeah, an
electrochemical
the word
process
that I was going to say too.
Without combustion. So I'm guessing it mostly runs on natural gas.
Whatever is the cheapest at any point in time.
Yeah. But I just would assume that natural gas is the easiest to access and most abundant.
Mm-hmm.
All right. How does it make money? Company generates revenue primarily through the sale and installation of its energy servers, as well as ongoing service and contracts. So we don't have the exact revenue breakdown. We can double check that in Fiscal. Who are its customers? Large enterprises, data centers, hospitals, and utility that require constant high quality power. Notable partners include Oracle and Brookfield, which recently announced a $5 billion investment to co-develop AI factory infrastructure. Yeah, that'll get the market's attention. Where does it operate? The US looks to be most of it, but it's expanding globally. I'm guessing Fiscal will have that. We'll check that out. How often do customers buy? This was my big concern with the company when I first looked at it.
Is that it could be very, very cyclical, yeah?
A one-time sale. I figured it was basically a one-time sale. The initial purchases are large, one-time capital expenditures, often involving long-term financing or power purchase agreements. These sales are supported by long-term service contracts, 10 to 20 years, providing a stream of recurring service revenue. Okay.
But the two things that matter there is, first, is it meaningful? Because
Correct.
If you sell something for $10 billion and the service contract is 100, like that's not, and then what are the margins?
The ratio of those two things matters.
Yeah. What is the gross profit for the long-term service contracts? That's the question.
Yep. Absolutely. Can it raise prices? The company faces a complex pricing environment where it benefits from specialized technology and high demand. It must compete with traditional grid electricity and other renewables. Margins have been historically challenged by high manufacturing costs, though it recently moved towards operating leverage, indicating improved unit economics. So I'm going to say my read on that is it's free to change prices. They're not regulated or they're not dictated by the market. But historically, its ability has been capped because it's competing against the utilities.
The market is saying you can't charge us that much.
But
We'll
with
get someone else.
AI data centers, power is everything, right? That is the
Mhm.
limiting factor. So that has, I bet that has dramatically shifted the stakes of a company to be this company now has pricing power, is my guess.
Mhm.
What happens in a recession? It's a capital intensive business and sensitive to interest rates, which can make financing new projects more expensive because the product provides mission critical power. Demand tends to be more resilient than discretionary spending. All right, so let's go over to fiscal and see which numbers here we can ascertain here because Gemini did struggle to pull it up. So first, let's start with the stock.
I can tell you a couple of them just because I went ahead and pulled it up. If you go to their the financials and then KPIs, one really helpful thing that they do is they talk about gross profit from each of these.
Oh, that's nice.
So you've got the product, but then you've got the revenue, but then you've got the gross profit.
Well,
And I
let's look
will
at their
say that
difference.
I think that your concerns were entirely justified
Yep.
in so much as the product is pulling in, $2
80% of
billion
revenue.
in revenue, and the service revenue is like a tenth of that. And then if you
Yep.
go down and look at the gross profit from the service revenue, it's nothing. It's $30 million.
Yep. $30 million versus 690. So for right now, in the long term, this could be like Intuitive Surgical, where those numbers flip with enough scale and enough
Absolutely.
time, right? And that would
Absolutely.
make the
But
business
they've got a way to go.
highly attractive.
Mm-hmm.
For now, this is a hardware, quote unquote, one-time sales business where the bulk of revenue is generated upfront from the initial product itself as well as the installation. I'm sure there's an upgrade cycle in here. I don't know how long the upgrade cycle was going to be. I'm guessing for something like a generator. I mean, what's the upgrade cycle on generators? 10 years, maybe 20 years?
Well, they said that
15 years?
the service revenue is 10 to 20 years, so that's got to be what the upgrade cycle is roughly. I do know that they do have a backlog that they call out down below as well.
Okay. We have some knowledgeable people in a lot of business. For the fee is around 20% of the initial price. Handy. So the surge margins are tiny and small relative to the whole pie. Yep, that would definitely be the case. Brandon, do they have a backlog? I don't know. We'll get into that.
Right
Maybe
down
that's
below.
a profit. All right. So product. Okay. Backlog 6 billion. Service backlog 14 billion.
So here's the thing about that, Feroldi. The thing that we got to remember is that product backlog, those are fuel cells that they're going to get placed as soon as they possibly can, right? That's the idea behind a product backlog. I wouldn't get too excited about the service backlog overall because that is over 10 to 20 years. Do you know what I mean? So like,
Yep.
whereas the product backlog is like immediate demand, the service backlog is not immediate demand. It's spread out over time.
Yeah. Either way, the thesis for this company for at least the next 5 years is selling more of the physical fuel cells and generating revenue from installations.
I would agree with our friend Ken, who would say that service, meaning the service backlog, can meaningfully increase over the next 3 to 5 years.
Yep.
Absolutely. It's important to understand that it's not the same as product backlog.
Yep, for sure. All right. Now we know about the business, a little bit of what they do. So red, yellow, green, if you're watching, we would love your vote. Red, this is a business that confuses you. Yellow, you get it. And you're kind of like, yeah, it's okay. Or green, man, is this a business that excites you? And I like to put, when I think about business that excites me, I think what the company does and the business model. I kind of combine those things together. But I would love to know what people here think.
Yeah. So far, we've got a yellow. I'll throw in there. We haven't talked about this as much, Brian, but I've been thinking a lot about the AI infrastructure stack and just kind of, again, where the bottlenecks are. And energy is just one of those things. Because of the energy being such a big bottleneck, I'm going with green. Otherwise, just based off of what we know, I would probably say yellow. And
Okay.
that's pretty much what we're getting from people as well.
Okay. Let me do something. I'm just going to resend a link really fast. I think the link that we sent people via email. That's why.
You got it?
Yeah. I am fixing that.
I appreciate that we've got long-term shareholders like Ken, and I think Brandon might be a long-term shareholder as well, who can chime in. It makes it a little bit less stocks from scratch, although for you and I, it pretty much is.
Yeah, I'm resending that right now. I sent the link to the one you did last week, which was a Zoom session.
Yes.
All right, sending that out now. All right, what is the general consensus from
I'd say yellow is the general consensus.
I'd say that's where my head is at. This is clearly an AI play, which is great, right? It's riding the right trend. It's got a product that definitely addresses a need from a business model perspective. I think in the long term, this could be a fabulous business model. The business model is not something that I like right now. That doesn't mean this company can't do fabulously well and have revenue growing and everything like that. You're betting on manufacturing and constantly selling more and more units, which has worked for lots of companies. It's just the recurring revenue is highly appealing to me as an investor, and this company does not yet have that.
The thing that confuses all of it is this, Brian. We're in a major super cycle upgrade for energy infrastructure, which I already talked about. But the thing is the ability to get those cells in a company's hands as soon as possible is like the most important thing right now. And I'm curious how many people can do that outside of Bloom.
Yep. Fair enough. Great. All right, cool. Moving on to the next one. Does this company have a moat? Now, moat is something that we're going to have you vote on, red, yellow, green, in a little bit. But there are 5 different sources of moats. There are 3 different states of a moat, and there are 3 different directions of a moat. Given what we know about Bloom Energy, what do you guys think is this company's moat source or biggest moat source right now? Is it network effect? Is it switching costs? Is it low cost production? Is it an intangible, or is it counter positioning? I'm really curious what you think about this.
Yeah, my guess is, so there's obviously switching costs, right? But right now, because we talked about that service revenue not being as big of a deal, I'm not sure how powerful that is.
Yep.
It will become more powerful in the future. My guess is that this is a combination of low cost producer and intangible as the key one today, with awareness that switching costs become more important in the future.
Yeah, I would go with my gut. My gut is intangible. Like this company has some IP or something that protects its product. I don't know what their competition looks like. That would be my guess here. I do think in the long term, the switching cost is definitely it for once you have these things installed and there's an agreement in place, no doubt about it. But we've already established that's about 5% of the business, right? I'm curious about the 95% of the business. What's the moat? What's the moat on that? So let's go ahead and ask Gemini here what it thinks the moat is for Bloom Energy.
Now, for what it's worth, one thing that's kind of interesting, I know Bloom reported their earnings and they were expected to have their revenue somewhere in the $500 million range, and it came in at $750 million, which is another reason why it has blown up so much.
NVIDIA like beats, basically, from like 2 years ago. Yeah. I mean, the more I learn about AI, everyone that's smart that I talk to is like, energy is the bottleneck. Energy is the bottleneck. So if this company helps to relieve that bottleneck, it makes sense that sales are exploding. Okay. Gemini says narrow moat, but the moat is widening. Switching costs and intangibles.
There you go.
It's transitioning from a niche clean energy provider to a critical AI infrastructure partner, leveraging long-term service contracts and unique on-site development speed. Its
Deployment speed.
backlog is 20 billion in 2026, roughly 10 times its
Now,
2025
again,
revenue.
a huge chunk of that is service, and you can only take 1/15 of that and say that'll be recognized.
Right. So this is quote when I think
That's
backlog,
the bigger number.
and when I think backlog, that's what I think.
Yes.
I don't think I don't think service backlog is really a backlog. That's more of like contracted future revenue from delivering on the thing. Backlog is we have orders for this and we can't fulfill them yet.
Right. That's not that, and that's not what the service is.
Right. So that's an important distinction there. Still big, still a big number that's going to grow, but I would say that. All right, switching costs. Bloom servers are mission critical for high uptime data. Once a customer integrates them, no doubt about it, right? Like once you sign up and the agreements are 10 to 20 years, collecting locked in relationships. I'm also guessing that those agreements that they signed are tied to the expected life of the device.
Yes.
So there's your upgrade.
That's roughly the upgrade cycle.
So there's a company out there called A.O. Smith, for example. A.O. Smith is one of the leading makers of hot water heaters in the world, and fabulous compounder, fabulous compounder. And if you think about our model here, you'd be like, how often do you buy a water heater? Like it's like 8 to 15 years or something like that. Well, they've been doing this for so long that their revenue is actually highly predictable because they've been selling these things into a developed market. So they can predict how many water heaters are going to fail every year and what market share they're going to get. And they've actually been stealing market share for a period of time. Bloom isn't there yet.
No.
As the business matures, I think even the product portion of its revenue will become more recurring like, but that's going to be years.
Well, it's also going to rely upon two things: not having their technology leapfrogged, which hot water heaters don't really have to worry about, and two, making sure that they stay relevant between now and then.
Yep. Yes, absolutely. Absolutely. So the product backlog reached 6 billion. Yes, that's the product backlog. 5 to 20 years. Bloom is rapidly becoming the standard and go-to choice for on-site power. Intangibles, significant intellectual property portfolio. Its unique fuel technology, higher efficiency, and fuel flexibility compared to competitors. Brand power is emerging. The primary value lies in its 1,000 global patents and 15-year head start in scaling this particular thing. Yeah, I would give
it. That's the big one.
I would also give it that. That's the plus just sheer business momentum. It almost becomes its own moat, for lack of a better word. They're not a low cost producer. They've struggled with high manufacturing costs. They're starting to, but they're not the low cost leader. It competes against power grid and other mature technologies. Like I wonder if somebody knows, is like Generac like a competitor for this company? Would like a standard home generator be a competing solution here?
I mean, I feel like two things. One, we're talking about something that powers a full data center. So, I mean, these fuel cells are enormous. I looked at pictures of them before we went on.
Okay.
But two, the bigger part is it takes all these different inputs. Most generators, you can't put hydrogen or natural gas or this or that. It's just gas. Whereas here, that's different.
So you get the flexibility of it. I'm guessing it's I don't know what the cost competitiveness is. And then it also says counterpositioning. So it's counterpositioned against traditional utilities. When utilities require 7 to 10 years for grid interconnection and massive infrastructure, it can deploy on-site power in as little as 90 days.
That's the thing. And I think this is what Ken was kind of talking about the implementation speed. You don't want to wait 7 years to get your data center online.
Absolutely not. So this is a speed to deployment thing, although they do have a backlog. So while they can do it in 90 days, you still have to get through their backlog as a customer. All right. I think I've learned competition from hydrogen focused peers like Plug Power and legacy diesel generator companies moving into clean energy. It surged. Morningstar rating gives it a fair value, blah, blah, blah. Narrow rating. Okay. So I would love to know how people vote on this one. Red, yellow, green. What do you think of this Moat? Red, there's none, or the moat's getting worse. Yellow, there's a narrow one, and it looks stable. Green, either the moat is wide today, or you think that it's expanding rapidly. I would love to know what people think of this, because I know how I would fill this in.
Yeah, I know how I would too. And it matches what I'm seeing coming in. Like right place, right time. This company has got it in spades.
All right. I'm actually going to go wide. I'm going to go green.
Tell me why. I'm surprised.
I'm going to disagree with people here. Because I see 3 narrow moats, but the most important thing to me, I personally value direction of moat more than I do over current state of moat.
Yep, that's fair.
To me, that matters more. I would rather invest in a company with no moat that's expanding than a wide moat that's under pressure. So
that's totally fair.
I think that this company Moat is definitely expanding. They have the counter positioning against utilities. They have the flexibility of the fuel. They have a wide patent portfolio. And they have the switching cost built in. I'm willing to give this company green.
That's totally fair. Ken agrees with you. He says green. Long-term uncertainty is there.
There's more to investing than just what's the moat and what's the state of it. But if forced to choose, I'm choosing green here. All right, next, long-term potential. Does this company have growth potential?
Boy, I'm really curious what it's going to say here.
All right, so let's go to fiscal first. So fiscal says this company has compounded its revenue about 22% over the last 3 years, 155% over the last 10. Over the next 2 years, revenue is expected to compound 75%. Earnings are expected to grow 86%. So that's the numbers we get from analysts, but it's important that we understand the story. Why is the company going to do that? What are the levers? Is it going to get new customers? Is it going to get more revenue from existing customers? Best case scenario, the answer is
it's got to be new customers.
That's also my guess. New customers.
Yeah.
Geographic and market expansion. All right. Sales and marketing, moderate. They rose a little bit. Yeah. So their spending rose all due to stock-based compensation. Boo. High confidence. New distribution, strong. Massive partnership with Brookfield. For those that don't know, Brookfield Asset Management is a unbelievably good asset manager based out of Canada. Big deal to get them as a partner. They're no slouch. To co-develop 1 gigawatt of power. Project Jupiter deal with Oracle. So those are some heavy hitter deals.
And I believe that's for a data center plan in New Mexico.
Yep. Okay. Geographic and market expansion, strong. Rapidly pivot into the AI data center vertical. It drew 134% growth. Expanding into power-starved hubs like Texas and Georgia, and targeting European industrial sites. It's worth saying when the Russia-Ukraine war started, power was a major concern, a major concern. So that can be a growth driver for this company in places like Europe.
Absolutely.
Acquisitions, it says none. Existing customers, pricing power is strong. GAAP gross margins expanded to 30%, up from 27%, despite rising scale, a premium for on-site power and speed.
Yeah, I actually that I don't think that's going to be a forever thing for them, but it definitely is right now.
There you go. New products and services strong. The commercial launch of the Bloom electrolyzer for green hydrogen. Management expects initial commercial hydrogen revenue scale in 2026 to 2027. So they're going after the hydrogen market. I've heard Elon say multiple times hydrogen is stupid, but apparently if customers believe otherwise, that's all that matters. Revenue is currently project-based emerging. Customer retention, moderate. Service revenue grew significantly. Gross margins jumping to 13%, up from 1%. Okay, so they're reaching enough scale with their service of business. I would guess that long-term service margins would match. Well, hard to know.
It is hard to know.
A company like Intuitive Surgical, service margins are 80%, 70%, something like that. I doubt they'll ever get that high. Well, I guess I don't know. I don't know what the surge margin potential there. All right. So number one growth driver, just market expansion, AI.
And
That's definitely what the
just to
market
be
needs.
clear, because I think there's a really like when we say new customers, it could be existing hyperscalers that are just buying more.
Absolutely.
So we're
Building.
just saying it's like a new site is like a
Yes.
new customer.
Yep. And that is recurring revenue in a sort, right? If let's just say Meta builds a new data center, tries this technology out, it works well, and then they build 5 more data centers and they reorder the same thing. That's the same customer. So as these companies have big investments in their pipeline and their data center capability, that can create you'll see that in the backlog though.
Yeah.
The backlog should go up. Okay, solid oxidized electrolyzer primarily provides a second multi-billion-dollar TAM in green hydrogen utilizing the same core manufacturing. Okay, service margin expansion, strategic capital partners, untapped opportunities is residential and small and medium-sized businesses. So AI, there's no doubt, just doing more in AI is going to be the growth driver for probably at least a couple of years.
Yeah.
At least a couple of years.
And that and by simple math, that's what helps them shift though, because the more product that gets there, the more service revenue they're signing for 5 to 20 years.
So red, yellow, green, what do you think of this company's growth potential? Red, poor or negative. Yellow looks good. Green, growth. The future looks very bright for this business. I have a feeling. I know what people are going to say.
Yeah, and I'm going to be in the same boat. If there's one thing that I've learned, we do have a couple yellows here.
Surprising.
It's that every time I've underestimated the power or the durability of the AI trend, I've been proven wrong.
Yep, me too. All right. So much for the Moat and the growth. We got the Moat growth potential. Up next, key metrics. So we're going to take a look at some key metrics for this business. Now, the key metrics that we're going to be looking at are revenue growth, operating margin, free cash flow margin, earnings versus estimates, and return on invested capital. With return on invested capital in particular, we just want to see a positive number. We're not looking for an impressive number. We just want to see that this number is positive. So I have and if you had to pick one, what really matters, it's probably, well, I guess they all kind of matter. I'd say
it's a combination of revenue and operating margin more than anything.
Yeah, something on those. All right. Well, we're going to try this with AI using our prompts. We're going to say that Bloom Energy is going to ask us what thing, and we're going to say Bloom BE phase 4. Oh, it did it. Okay. Now for these numbers here, I do not trust Gemini or any AI to give me exact numbers because they have a sense of changing them a little bit, but we'll double check all of these, but it's just good to see what does the AI think immediately. So according to AI, green, 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 yellow, green. Pretty good. Let's take a look at these in more detail. So over the last 3 years, revenue growth is 22.5%. AI said 22.8. Got that one right. Operating margin. This says 9.6% on a GAAP basis. So in fiscal, we go to financials, close down a whole bunch of these. And then we're going to go to
ratios.
Was it operating margin?
Oh, yeah, it's right there. Forgot.
Is
it 6.7%?
Operating margin. Yep.
Now that's over a trailing 12 months. It might have even improved a bit.
Let's do quarterly.
Quarter. Yeah.
There you go. Wow, it got up to 18%. I'm guessing there's a tax thing in there. You don't normally see something that high because the gross margin on this company is like 30%.
Yeah.
So 9.6% operating margin as of right now. That is definitely improved and it's definitely positive. So good. And this number in particular, the next couple of years of growth should be really good. Free cash flow margin. Is the company converting its earnings into cash flow? So we're going to go to ratios.
I'd be curious to find out about this.
Yep. I'll keep that one going so we can compare them. And then we're going to scroll down to margins. And then we're going to look at free cash flow margin.
Wow.
So the blue line here is what we were looking at. 83% free cash flow margins in one period. That's a neat trick when you have higher free cash flow margins than gross margins.
That's what happens when people pay for stuff up front.
50% one as well. But
yeah, we should probably look at this on a annual basis instead of a quarterly basis.
Yeah, look, you can see that it's seasonal, right?
Yep.
This is quarterly. So let's go to annual to make it to try and get rid of that seasonality that we're seeing. Yeah, that's much smoother.
There we go. That makes more sense.
But pretty close to the operating margins. That's surprising to me as a company that's investing heavily in manufacturing, that they're free cash flow positive already with almost, is that 10%? 9.4% free cash flow margins. Wow. Color me pleasantly surprised by that. Okay. Earnings versus estimates. So we'll click over to estimates and we're going to focus on earnings for the time being. And we're going to go quarterly. Can you see that okay?
Yep. You can zoom in a little.
Okay. So the actual...
Those are annual, just for what it's worth.
Oh, yeah. We want quarterly. Thank you. Actually, they Fiscal just launched a new thing this week. They color coded them. So now, beat, miss, beat, miss.
Yeah, it doesn't look great. Do the revenue ones real quick though.
Yep. I care more about revenue than I do earnings.
Yeah.
Beat, miss. So the inflection here has been since
the last 6 have been there.
Yeah. And you mentioned that it was like
crazy. If you hover over it, it might tell you. So March 240 was what was expected, or sorry, 540 was what was expected.
Yeah.
750 is what, I mean, that's
enormous.
That delta is
enormous
insanity.
Enormous beat, a big beat. Yeah. So, I'll go ahead and give them a yellow.
They're getting wider too.
Yeah. To me, this is management's primary job. Management's primary job is to take the story that it's telling and turn it into numbers.
Mm-hmm.
They struggled with that for a couple of years, which is why their stock languished. Over the last 5 quarters, they have done a great job of turning a story into numbers. All right, final thing we're going to look at is return on invested capital. We just want to see for a company that's in the operating leverage phase, like this company is, that it is earning a positive return on its invested capital. It's too early to get this number a really clean view, but let's take a look at what we see. All right, capital efficiency, 7%. So again, that's not an impressive number on its own.
But look at the direction.
Given that the company is not yet fully scaled, nowhere near fully scaled, the fact that it's reporting positive return on invested capital at all is a very good sign. So great job on the key metrics. This company is scoring better than I thought it was going to before we started here. But valuation is coming up. All right, let's take next a look at the execution risk of this business. So execution risk. And let's see what this company's biggest execution problems could be. Oh, well, it says concentration and outside forces. That's not good. With some mitigation factors there.
Makes sense that concentration. It's just like a chip maker. Like they're going to be selling to the same 5 companies.
Yep. All right. Concentration risk, red. They have expanding partnerships. They're highly dependent on a few massive hyperscaler contracts, Oracle and Brookfield. So that's the downside of those contracts, is if they ever get pulled away, look out below. Disruption, green. They are the disruptor. Love to see that. Outside forces, high exposure to natural gas, biogas, commodity prices, and regulatory tax credits. What I'm debating in my mind is, while that's true, aren't there competitors?
Yeah.
Wouldn't utilities are exposed to the same thing? Their competitors
and what I would say too is that having multiple inputs that you can use gives you more flex. It makes you more anti-fragile. It makes you more flexible.
Yeah.
If one goes down, another goes up, you can use the
Right.
one that went down.
So while this is true, that's almost an advantage for them. The more wild those prices get, the more it seems like the better choice. They have a $2.2 billion, 0% convertible note. All right. Competition, normal from legacy diesel generator companies and emerging hybrids like Plug Power, Boom, solid oxide, and massive employee base. Scale advantage that keeps it ahead of small startups. So concentration is a risk. Concentration is a risk. Disruption is not. Outside forces is. I would probably go yellow on that one. Competition, I would personally call yellow. Offsetting those risks are the AI infrastructure super cycle. Their strong financial position, their backlog, and their speed. Red, yellow, green. What do you guys think of the execution risk here? Red, very high. Yellow, medium. Green, low. When filling this out for myself, I like to think through the execution that I've already seen. What has the company done since it's been public? So again, we saw mixed track record there. Actually, we haven't looked at just pure revenue yet. Did revenue look pretty good?
In terms of
what you want to see as an investor?
Yeah, I mean, I think that they had a technology that was used by like places that can't lose their power, so hospitals, so that the machines don't turn off. And so this was like a brand new thing that their technology was perfectly placed for.
Wow.
We're seeing a lot of different things here. We've got some reds and yellows, got a yellow trending green.
Yeah.
But I would say yellowish red is the average here.
Okay. I would go yellowish red myself. Execution here requires scaling, keeping the competition away, taking advantage of a market opportunity. Now they have been doing that pretty well so far. So I'll call it yellow. I don't think this is like crazy high risk, especially actually. I'm going to go pure yellow. I'll say pure yellow. They are profitable and free cash flow positive.
Yep.
Okay. Final check. How about the company's valuation here? Yeah, this one could be very interesting. Okay, good. Execution risk. Up next is valuation. So the final step here is to look at the company's valuation. Now, for a phase 4 company that's in operating leverage, as I teed up before, we want to look forward because the company is growing so rapidly. The earnings are growing so rapidly. Let's take a look at the forward price to earnings and the forward price to free cash flow. That's probably going to be our best bet for analyzing this company's valuation. If my voice sounds a little raspy, I'm getting over a cold, which I think I gave to Stoffel.
Yep, that's right. It's what happens when you go stay in the same city.
That's right. Forward earnings, first off. What? Okay. It said 30 times before. I was like, this company's trading at 30 times earnings? All right. So we got to get rid of this. Got to get rid of this craziness here. So if we go to quarterly, might get a more granulated view.
There we go. So
June?
July 23, pull it forward to there.
Oh, July 23.
There you go.
All right. Here's a clean look for us. So it's hovered. Remember, these are forward numbers. So next year's earnings estimates, 129 times forward earnings. And I'm guessing the average was as low as 20 times previously when the growth was much lower. If we were to average that out, 60 times on average over the last.
So it's hard because it's a small window of comparison, and the world has changed over that time
Dramatically. Right? Yeah, the story changed over the last 5 quarters, right? The story definitely changed. But at the very least, you can't call that number cheap.
No.
To me. Now let's take a look at forward price to free cash flow. All right, looks like free cash flow started in January of 2025. So let's buzz that forward to June of 2025. Yeah. Okay, so we'll mute that one. 429 times forward price to free cash flow. And we do know that this company's price to free cash flow margin is about 10%. Now, I don't know if that's carrying over in the estimates. I don't know if that was a one-time thing or it's a sustainable number or not. But if you're looking at a free cash flow basis, holy valuation, Batman, 400 times price to free cash flow. Now, since we're here, let's also take a look at forward price to sales. That might be something to look at. 20 times sales. 20 times forward sales. This is a company that was trading at 2 times sales, now 20. Now, when thinking about price to sales, I always like to adjust for margins. If a company has the ability like Visa to generate 50% free cash flow margins, I'm very lenient with the price to sales number that I see. What do you think is this company's scaled margins? What would be your guess?
Well, so that's the thing. Like I'm going to go on a little tangent here, but there's a reason. So we did Intel a couple of weeks ago, and one thing we didn't do is we didn't talk about how much could their margins expand. So I was like, that was an oversight because Intel's basically doubled since then. I don't know if it would have changed that much, our response, but I looked at Bloom's free cash flow margins. And even though they do have 10% right now, a good chunk of that does come from stock-based compensation. My guess is that they would have a free cash flow margin of between 10 and 15% once fully optimized. And there won't be that stock-based compensation in there. So that's it. It's pretty much like a doubling of their margins. But if you suss out the stock-based compensation. So I don't think that there's definitely some leverage in there, but not in a ridiculous amount.
Okay. On an annualized basis, yeah, let's just double click on what you just said. I'll show this on screen. So what Stoffel just did is he took a look at the company's cash flow statement and said, all right, they're doing 300 million in cash from operations. They're only spending 70 million on capital expenditures.
So that means their IP is valuable.
That's not as high as I thought it was going to be for manufacturing in-demand product like this. All right, but what are their sources of cash flow? Their net income was 10 million, depreciation is 60, stock-based comp is 160.
We don't know what the other adjustments are.
Working capital is working against them. Accrued expenses, payables. All right, so they have some working capital.
The bottom line too is just that stock-based compensation is about half of free cash flow. So instead of 10, give them 5 for your own purposes. So if they can get from there to 10, that's a doubling, but it keeps the numbers today more or less the same.
Correct. Yeah, it would be more real cash flow versus manufactured free cash flow. But yeah, even if I think if you're very generous and say this company can get to 20% sustainable free cash flow margins, I think that would be pretty generous. That would mean that the company is currently trading at optimized free cash flow of next year's of 210. If you're willing to give them a 20% long-term free cash flow.
Now, that being said, pull up their revenue growth rates and then pull it forward so we can see what's expected, because this is, well, just I think looking at it is important because the number that you will see here is kind of mind-boggling. Because right now they're doing $2.5 billion in revenue. By 2029, they're expected to be at $6 billion.
Wow.
So, I mean, that's a lot of growth.
Yep.
And on mine, I can pull it out to 2028. I don't know why. Maybe I've got the fancier version. 2028. It's expected to get to 9.3 billion.
9 billion.
Yeah.
In 3 years.
Yep.
All right. So 9 billion. Put a 10% free cash flow margin on that. That's and we'll let's call it
$1 billion.
$1 billion in free cash flow in 3 years. And the market cap today was 80 billion. 83 billion. So you're paying 83 times
2028's free cash.
2028's cash flow, assuming all of that revenue growth is correct. Now, with companies like this that hit super cycles, it's very possible those estimates are low.
Right. It could be 12 billion.
Yeah.
And it could be a 15% free cash flow margin.
Absolutely. Absolutely. This is why valuation is tricky, especially for hyper growers. If you want to assume, well, those growth estimates are low, they're going to get to 20 billion in revenue in 3 years. Might be hard for a manufacturing company, really hard for a manufacturing company, and their margins are going to go to 15%. Right? Then you're talking about 3 billion in free cash flow, and they're only trading at 27 times that optimistic scenario for a company growing very, very quickly. So, but the point is the stock today cheap, fairly valued, or expensive? I don't even think we have to ask the audience on this. I don't know how you not say it's expensive. Like, you're betting on a whole bunch of optimism.
We should say it's expensive with this caveat that trying to guess the growth rate of something that takes the world by storm is the most difficult thing to do.
Yep.
Because a growth rate of like 100% over a couple of years and 200%, like, you could actually get a delta between those two things that like, it might make sense to be off by that much. But if you are, that totally changes the valuation.
It absolutely does. The other thing to note is that it can be very tricky to value companies that have hit a massive inflection point.
Oh yeah.
Like, if you look back when did Nvidia hit its massive inflection point? 2020,
like 2023.
Yeah. Every number. So the stock was going vertical, and every number said this thing is crazy expensive. Like, crazy expensive. But the results were so outrageously good and continue to be so outrageously good. Looking back, the stock actually looks, I don't know about cheap, but fairly valued. So sometimes when the numbers are changing so rapidly, determining fair value of a company can be extremely difficult. We should also point out, we are fundamental investors, primarily. If this is in the world of momentum investing or technical analysis, if that's how people are looking at this stock, anything can happen to the valuation from So we're not saying don't buy it if you don't like it, or that it's not going to do well. We're just saying, from a fundamental analysis perspective, you have to be very optimistic with your expectations for this valuation to make sense.
Yep.
All right. Great. Let me go back.
I even went and I cheated and I went to see what our new stock simplifier said about the Moat.
I was literally just doing that exact same thing. Yeah. What does it say?
Well, do you want to share it?
Yeah, I'll share.
Yeah, you should share it.
I'll share my screen. So, well, actually, before we do that, let's do a sentiment analysis on it. I do want to see the sentiment on this company. So we do have another prompt that is all about analyzing the sentiment that the company has right now. And I'm guessing the sentiment on this company is going to be extremely strong right now. Hard for stock knocks to 10x and for that to happen. All right. Over the last year, it skyrocketed due to the time to power.
Those 90
demand.
days are important.
Yeah. Time to power demand and massive Q1 earnings beat and the landmark Oracle deal. Next catalyst is August of 2026. The outlook from fundamentals are at record high. The stock has surged and current price levels sit well above the analyst price targets. So analysts are bullish, investors are neutral, and the media is positive. The bulls say the AI energy bottleneck is real. This company moves way faster than utilities. The backlog is growing, and it's operating leverage. All true.
Yep.
All true, in my opinion. The bears say, well, the valuation has gotten way ahead of itself. Insiders are selling, and the concentration risk should not be ignored. All right, all fair enough. All right, before we move on, I do want to show you what the new stock simplifier that we are launching later this month says about it. So here's what the new stock simplifier looks like. And we have here a new management assessment tab. And this is something we do not do in the original one. So let's see. So stock simplifier says that the AI, the management team here is decent, 3 out of 5. Founder and CEO Sridhar built fuel cell technology from a NASA project to $2 billion in revenue over 25 years, but it took 2 decades and lots of dilution. The pivot to capture AI demand, but they have heavy debt limits versus net income, and a new CFO was just brought in. Do employees like working here? Not really.
No, I would say not.
Do they beat expectations? Mixed. Are they shareholder friendly? No. And how strong are margins? Mixed there. Now, we also have a very deep dive analysis here into the company that you can do if you are a user of Stock Simplifier Pro. And it goes much deeper into who the CEO is. He's been at the company for 25 years, what his background is, what his leadership is, how much stock he owns. Same thing with the CFO, which the new one just came in. Details on employee sentiment, on shareholder alignment, expectations versus what they have, and a financial number with what to watch. So this is the kind of analysis that is built into the new Stock Simplifier. We think you guys are absolutely going to love it. It is not yet available. It is still in beta. We're ironing out the last few bugs. This will be available in sometime later this month to our waitlist and our waitlist only. Stoffel, if you could share the link to the waitlist, I'll put it up on screen so people can kind of see that there. So longtermmindset.co/waitlist. If you put your email into there, we'll let you know once it's available. Once it's publicly available. We are launching it only to the waitlist first. The waitlist is going to get first access to it. They're going to get a discount on getting it. They're going to get at least a 2-week head start on being available to the general public. And signing up for the waitlist is free. So longtermmindset.co/waitlist if you want to dramatically speed up the stock research process. We think people are going to absolutely love it. All right, with that out of the way, Brian, I would love to ask the audience here, overall, given what we know about this company, this is a business that we said was yellow, a very rapidly expanding moat, high potential. It scored quite well on all of the key metrics that we look at. The execution risk here was moderate. It was overvalued, at least according to fundamental traditional analysis. And the management team was middle of the road. Take all of that in. What do you guys think of Bloom Energy stock today? Red, this is a company that does not interest me in any form. It's a pass for me. I remove it from my watch list. Yellow could mean interesting. I'm interested in this business, and I think it could be a right buy at the correct price, but right now isn't that correct price. And then green is, I think this is a fascinating company. It's worth adding to my portfolio at current prices. What's the
everyone so far saying the same thing, which is yellow. Let me just tell you what I would say. And this is not meaning that this is what I'm going to do. For myself, when I have companies that, like Susanna is saying here, yellow, too expensive right now, I would always say that you can always buy a teeny tiny bit. And if it just keeps going up and up, you'll be glad that you got that teeny tiny bit. So I'm not saying that that's what you should do, but I'm saying that it's not black and white. It's not like it's a 10% position or nothing. There's lots of gray.
Absolutely. Yep. Absolutely. This is a fascinating stock. It's an $80 billion company right now. The future is very bright for this business. Very, very, very bright for this. I completely understand why the market has gone from, oh, this is a mediocre so-so performer to, wow, this is an exciting company. I think they have a differentiated product in a hot market. Margins are probably going to be strong. Growth are going to be strong for at least a couple of years until something else comes along and really knocks them off their horse. But I understand why this company is up so much, because it has dramatically changed over the last couple of months.
Agreed. All right. Well, when we come back next month, hopefully both of us will have recovered, because we both sound pretty raspy today.
Yeah, we do. Yeah, we do. I'm at the end of my voice being able to hold up. Thank you guys for tolerating some technical issues at the start and for my nasaliness towards the end here. Thanks so much for watching this video. Again, if you want to get on the wait list for the new stock simplifier, longtermmindset.co/waitlist. It's free to join, and we will let everyone know what is happening as soon as we have a launch date in mind. With that in mind, thank you guys so much for being here. We will see you in 1 week for another Stocks from Scratch. Brian's out.